So, ladies and gentlemen, you're looking at IFRS 16. IFRS 16. IFRS 16. I don't like the lighting. This lighting is too much. We shall overcome. That lighting is too much. All right. So whenever we talk of IFRS 16, then what are we supposed to be thinking about? So whenever we talk about IFRS 16, we are supposed to be thinking about leases. Now, remember, by definition, what are leases here? Now, under leases, we are going to be having two parties involved. So we have the landlord, or rather the owner of the asset, called the lessor, and then we have, in this case here, the lessee. So if I look at this from the aspect of a building, then the lessor will be the owner of the building, who is called who? The landlord, and then the lessee will be the tenant. Now, ladies and gentlemen, whenever we talk about IFRS 16, according to the definition of the IFRS 16, whenever we talk about lease contracts, basically a lease contract is that contract which conveys the right of use. It conveys, in this case here, the right of use to a party known as who? Known as the lessor, known as the lessee. So under a lease contract, ladies and gentlemen, conveys what we are calling right of what here? Right of use of an asset. So meaning that the lessee will be having the right to use this asset to a party known as who? A lessee. To a party known as a lessee. And this right is not being given forever. The time will be very, very much stated there. So for a specified time, at an amount known as what we shall be calling lease rentals. So ladies and gentlemen, please listen. I'm repeating again that under lease contracts, we are going to have the major party. The major party is known as what here? The lessor, conveying the right of use of his or her asset to another party known as who? The lessee. And then this lessee, of course, will stay with this right to use of this asset for a specified duration. In town here, for example, RCM, we have leased a property called Stanbank House for 5 years. For 5 years. For 5 what year? For 5 years. For 5 years. For 5 years. So in this case, we are saying, and we're repeating here that the time of usage must be specified. And then, of course, you are paying like a monthly lease rental of, say, 100,000 Kenya shillings. So then I have a handout here. This handout here will be able to help us crash through these concepts here very fast. So I want to share here this handout that everybody has. So IFRS 16, of course, we are reaching out to you, ladies and gentlemen, with a free class from RCM Online College. This is our number here, 0719 525,000. Later on, after, of course, you guys listen here, I'll be welcoming you to come and study with us. So it's quite an old standard now. We can't say it's new. Yeah, you can see the effective date was 1st January 2019. So it's about 4 years old. What is the objective of this standard? To improve the transparency and the comparability of lease accounting. What are the key changes from the old lease standard? So the key changes, number one, we have single model for leases. So lessees must recognize nearly all leases on the balance sheet. So remember, the old standard used to classify leases into operating. The old lease standard used to classify leases as operating leases, stroke what here? Financing leases like that. Operating leases were those ones they were calling short-term, all right? And because they were short-term, then they were not being included in the balance sheet. They were being expensed in the income statement. So in this case, you're operating like that. These are long-term. The IFRS 16 current one looks at what we call a single lease model, that all leases must appear in the balance sheet. The concept of saying that operating leases here should be off balance, that one no longer works. That one no longer works. And then number two, ladies and gentlemen, what are they telling us here? The right of use of an asset here. Lessees record a right of use, ROU, asset, and a lease liability for each use. Ladies and gentlemen, at RCM Standbank House, we've been given the right to use some space there on the first floor. So when I'm given this space to use there at the first floor, remember for those 5 years, the landlord will not be interfering with my space. So then this right of use becomes an asset. So I'll be able to book under my non-current assets, I'll be able to book an asset called right of use, ROU. Why are we calling it an asset? Remember, an asset is any resource that you are able to control yourself, right? That you are able to define its usage very well, right? And of course, you expect to get what we call economic future benefits. In the future, you expect, in this case, to get benefits out of it. Now, because of the space you've been given at Standbank, so we ourselves as the RCM management, we are able to state that we are going to use this space for training purposes. When the students pay fees, whom do they pay these fees to? They don't pay the fees to the landlord of Standbank, no. They pay the fees to RCM. And that is why then the right of use of this asset will be of Standbank. We're going to recognize the right of using Standbank House, the first floor there, as an asset. And then at the same time, remember, we shall be paying this landlord not at once. We shall be paying this landlord maybe monthly rentals or quarterly rentals. So meaning that from the word go, when we sign that lease contract, I've signed, in this case here, a contract that gives me right of usage, so I should be able to recognize an asset, and I've signed a contract which tells me that, hey, you owe this landlord, and we'll be paying this landlord like this. So two things, I'll be booking an asset. Once I sign the lease, I'll be booking an asset, and then number two, under the name called ROU, right of use, and then number two, I'll be booking a liability, and as we shall be seeing, we shall be booking what we call present value of lease liability. Present value of lease liability, very, very important. Okay, gentlemen, we continue here. We are told here, lease liability recognized at the present value of future lease payments. So key definitions. A lease is a contract that conveys the right to use an asset for a period in exchange for some consideration. It cannot be for free. It cannot be for free. And my students, there is something that I would want you to appreciate from the word go. These are mistakes that some of us have made in business. These are mistakes that some of us have made in business. And given that we are mentoring you, so that you don't get to enter into the kind of ditches, the kind of financial mistakes we have always found ourselves in future. So like, for example, RCM, we are doing a primary school. You'll be seeing us advertising it. Most probably by 2026, it should be running, right, in Kajiado. So what we did, we went and bought what here? 15 acres of land. We bought 15 acres of land. I mean, each acre here is very, very costly because it's land which is very near the road. Very costly, all right? Had we known, if, for example, I had the knowledge that I have today, what I would have done is to lease. I would have leased, in this case here, these 15 acres. So if I lease these 15 acres, trust you me, per year, even if it's really a very strategically located asset, per year, these guys here can charge us something like what here? 20,000 per acre. 20,000 per acre. So then I'll come and multiply this with what here? With 15 acres. With 15 acres. All right? That is per year. And then, of course, because I would want to build very executive places here, I would request for a 20-year what year? I would request for a 20-year lease term. So you see, if we had leased, the money that we put into building, the money that we put into buying the land would have been put into straight away building. And then now we are very, very bright, because once you enter into this kind of a contract, then of course you have your lawyer. The lessee, the lessor, also has his lawyer. So you sit down, you say after 20 years, what happens? Number one, within these 20 years, if I'm a prudent businessman, If I know what I'm doing, I know proper marketing, I know proper control systems, in 20 years, I would have recouped quite a lot of money. I would have recouped, in this case here, a lot of money, including the money that I've put into buildings. And again, to safeguard my interest, what I will do with the two lawyers, we sit down, we say after 20 years are over, then I should be given what we call an option to buy. An option to buy this particular land at the prevailing market rate. At the prevailing market rate. And you ensure that the market rate prevailing will be measured by a registered government valuer. That's how you put it in law. Otherwise, that time will come and somebody will try to play some monkey games. They'll tell you that this land is now valued at $1 billion shillings, because they are eyeing your properties there. So in this case here, you put that it is a lease, but now with an option to do what? To buy. Is there somebody in this case here who believes, that leases are very, very powerful? Or do you believe in owning? Is there somebody who believes that leases are very, very powerful? Is there somebody, for example, who is working for a company that is big in leasing like motor vehicles? They don't own. You know, when I lease, like for example, major repair costs will not be borne by myself. I'll always return that vehicle to the lessor. All right? There are so many advantages, yes. There are so many advantages here. Yeah, great. So this is very, very important. I mean, it's a high time, you know, like outside there, when you go out there, like in European countries, rarely do people own, I mean, when you own a big building, it ties up your cash. For example, you go putting up these big apartments where, for example, in Ngong, today they look very fancy, they look very new, it is your building, but trust you me, 20 years down the line, that building could be a ghetto. You are better off in this case here, just leasing, and then you transfer the risk of obsolescence to the owner. So leasing is the way to go. Leasing is the way to go. This concept of saying that we must own, no, you don't have to own. You can still lease, like in town here, people are leasing properties, and then at the end of the day, if the lease contract is very good, it will favor you. And within the lease period, you would have, in this case here, gotten a lot of money. Yeah, like mostly companies lease photocopiers here. They lease photocopiers. So lease is the way to go. So then we come here straight, ladies and gentlemen, we are told something very, very important here. We have a lessor, the party that provides the right to use an asset under a lease. So the owner is the lessor. Lessee is the party that obtains the right to use this asset. So like if it's a house, then the lessee becomes who? The lessee becomes the tenant. We have right of use. Right of use, an asset that represents a lessee's right to use an underlying asset for the lease term. So we have these definitions. I'm going to give you this handout, ladies and gentlemen. In the interest of time, I would want us to look at a question. Let's look at a question here. Because I'm supposed to be ending this class in exactly 20 minutes from now. Because I would want you to get like 10 minutes here before you get to your workstations. You should be able to at least relax a little bit. So we are told here Royal Contractors Limited owns an item of plant used for construction with a carrying value of 14 million as at 31st December 2015. The firm won a construction contract and decided to sell and lease back the machine on that date under the following conditions. The selling price is 40. This was also the fair value of the plant. Lease rentals payable annually in arrears amounted to 15,521,000 and the Kenya shillings 200. The lease duration for the machine was to be 3 years. The economic life of the machine was also 3 years. The implicit interest rate is 8% per annum. So they want us to give them the journal entries to record the necessary transactions in the books of Royal Contractors Limited. In the books of Royal Contractors Limited for the 3 years, including the expected entries at the end of year 2018. Now, ladies and gentlemen, we must know who Royal Contractors now are in this arrangement. Remember, Royal Contractors initially owned this particular what year? building, item of plant. They owned this item of plant. But what did they do? These great ninjas, they found themselves in a problem of financial difficulties. So they sold this item of plant and then decided to lease it back. It is what we call sale and leaseback transactions. Sale and leaseback transactions. Sale and leaseback transactions. Felicitas, these are free of charge class. It's going to take maximum 40 minutes. 40 minutes. Now, ladies and gentlemen, please listen. Look at, for example, what Uchumi Supermarket did. Uchumi Supermarket, of course, you are very much aware that their headquarters, head office, was this one that is at Aga Khan Walk. You guys, have you ever seen, you must be knowing where Uchumi Supermarket headquarters was. So we know that Uchumi at some point in time, it got itself in financial problems. They were owning these headquarters. So what they did, they sold to release their working capital. They sold the building. So in this case here, they got good monies. And then in this case here, because their customers were so much used to this Aga Khan Walk branch, what they do after they sold, they sat down with the landlord and told the landlord, no, you can't just no. Let us be your first tenant. Let us be your first tenant. You've just bought this thing. We don't want you to give tenancy to any other person. Let's be your first tenant. So in this case here, they did what we call a sale and what here somebody leaseback transaction. Leaseback transaction. So this is what these royal contractors have done. They have sold and now they have become tenants. So in short, these particular royal contractors, these are who? Royal contractors, these are who in this transaction, they are lessees. They are lessees. They are lessees. Because they sold their right to be what here? To be a landlord. They sold the item of plant. And then now they came and leased. So if it was a house, we would have said that royal contractors are what here? Tenants. So you see, in accordance to IFRS 16, how a tenant does the accounting will be different from how a landlord does their accounting. So it will be very important for you to define the position of the company in question. So they want us to do this lease accounting under the books of royal contractors. And who are these royal contractors in this regard? Because they sold and leased back, they're the lessees. And if they're the lessees, then the very first thing you do according to IFRS 16, if these are lessees, so we are doing lessee accounting, we are doing lessee accounting. And if they are lessees, ladies and gentlemen, the very first thing you shall do is to give us their total liability in this lease contract. The very first thing you shall do is to give us their total liability. Because now they'll be paying lease rentals gradually. But now come and give us their total liability. And to get this total liability, we shall get what we call present value of lease liability. Present value of lease liability. Present value of lease liability. Now this, of course, is also known as what here? Fair value. The fair value of the asset. The fair value of the asset, because at the end of the day, I will be paying, the fair value, market value. At the end of the day, when I pay like this, whatever I'm paying should be equivalent to the market value. So whenever you see fair value of the asset, this will be the same as your present value of lease of lease liability. Please listen. This is a question that we should be able to understand, all of us. It's a question that we should be able to understand, all of us. If you look at this very well, they are telling us the selling price of this particular plant is 40 million. And this was also the fair value of the plant. So the fair value of the plant is given. The fair value of the plant is given. Please allow me to capture these figures in millions. But you see, most of these examiners can never give you the fair value. They would want you to compute the fair value yourself. You shall be required to compute the fair value yourself. You shall be required to compute the fair value yourself. So method number two. To get this present value of lease liability, what we shall do is to take the rental amount. The rental amount, they've given us 15 point something. 15, they've given us 15. Let me see, this figure looks ugly. Let me see this figure. It looks ugly. They have given me rental of 15 here. Lease rentals are 15, 521, 200. 15, 521, and then we have 200 like that. So please allow me just to write this 40 million in full, because I've seen this other figure is very, very ugly. I may not want to cut the zeros. It will not look very nice. Let me just write it in full. 40 million. And this is now the lease rental. Now, this lease rental, ladies and gentlemen, remember they have told us clearly. What they have told us is that this lease rental will be paid at the end of each year. They have told us here, lease rentals payable annually in arrears. They are payable annually, but in arrears, amounted to 15, 521, 200. So an amount is paid in arrears. It means that it is paid at the end. So it's paid at the end of the year. Ladies and gentlemen, this is a great cash flow. There are two types of cash flows in lease rentals. You can either get what we call irregular amounts, which in this case you are graduated. We were told that year one, the rent will be this much. But year two, rent will be growing by 10%. Every year, 10%. Then those will be irregular cash flows. But you see now, this one is a regular cash flow. It's a regular cash flow that I'll be receiving every year. So I want to bring it to your attention here that there are two types of cash flows, remember. Remember, there are two types of what here? There are two types of cash flows. There are two types of cash flows. Number one, we have what we call, Number one, we have what we call irregular. We have what we call irregular cash flows. We have what we call irregular cash flows. And then number two, we have the regular cash flows. These regular cash flows are the ones we call annuities. These are the ones we call annuities, or in this case here, what here? Or uniform. These are the ones we call annuities or uniform. So you've got two types of cash flows. We have cash flows that are what here? Regular, annuities stroke uniform. And then we have cash flows which are what here? Irregular. If you're writing, please remember that to discount these ones. These ones here which are irregular, we shall always discount them using PVIF. We shall always discount them using PVIF. And the regular ones, we shall always discount them using PVFA. So whenever it comes to discounting irregular, you shall use PVIF. So, and the PVIF stands for what here? PVIF stands for present value interest factor. PVIF stands for present value interest factor. And then we have a PVFA, which stands for present value interest factor of an annuity. Present value interest factor of an annuity. Present value interest factor of an annuity. Once you guys write up to here, could you kindly, ladies and gentlemen, once you write up to here, could you kindly, ladies and gentlemen, please give me a thumbs up? Once you write up to here, are you able to give me a thumbs up? Once you write up to here, please give me a thumbs up. Once you write up to here, kindly give me a thumbs up, somebody. A thumbs up to show that we are together. Yeah, at least I can see one thumbs up there. Thank you so much. Now, please listen. I'll be able to give you the two formulas. Anytime you see the word PVIF, there is a formula that we used to work with in high school. So anytime we see the formula PVIF, I will always remember this formula, 1 plus R raised to negative N. Very, very important formula. 1 plus R raised to negative N. That's PVIF. It comes from that formula of a high school, amount equals principal into something. Very, very important, PVIF for the irregular cash flows. And then whenever we see PVFA, we normally take 1 minus this simple formula, which is 1 plus R raised to negative N, and then everything to be divided by R. Everything to be divided by R. So I like PVFA because PVFA is a child of PVIF. Once you give me the PVIF formula, then I'll be able to give you the PVFA formula with an A. That means annuity, regularity. So it will be 1 minus this simple formula, and then not this part alone, but everything to be divided by R. Now, let me, ladies and gentlemen, ask you a question. This figure here, according to you, is it going to be a uniform cash flow or is it going to be irregular? Please answer me. This figure you are seeing here, is it going to be uniform or irregular? This figure, uniform. Thank you very much. Uniform, because this, look at the question itself. Look at the question itself. What is the question telling us? It's regular, yes. What is the question telling us? You can see lease rentals payable who? Annually, every year. Every year. It is 15,521,000 and then 200 every year. Every year. So this is an annuity. And therefore, to get present value of this lease liability, I will take this annuity amount, and because it is regular, then I will come and multiply it with the PVFA. I will come and multiply it with the PVFA. I will multiply this with the PVFA to discount this. Remember, it will be over a period of 3 years, and they have given us, in this case here, the interest rate, which is 8%. They've given us the interest rate, which is what here? Which is 8%. They have told us, ladies and gentlemen, here, they have told us lease duration for the machine is 3 years, and the economic life of the machine was also what year? 3 years. Of course, to discount here, because we are the lessees, we shall use, in this case here, we're going to see this later on. You know, you could be given a big lease duration, but the economic life of the machine is shorter. And I've seen this kind of a question being asked in the advanced financial reporting, So you're given like a lease duration, long one. But when you start using this machine, you realize, so they have given you, for example, a lease duration of 10 years, but you realize that the economic life for this machine is 7 years. So whenever it comes to discounting, even depreciation, ladies and gentlemen, we shall always be working with the lower. I shall be able to come to that. But for now, we can see the lease duration is 3 years and the economic life of the machine is 3 years. So no worries for now. This is our first question, remember. Everything simplified. So the most important thing is that we're going to have this for 3 years, and then the implicit rate of interest is 8%. The rate of interest is our cost of capital, is our required return. Is this R. So R is 8%. R is 8%, which is the same as 0.08. And then, of course, we have our N is 3. So can we kindly come and plug in here? So we shall be able to say here 1 minus into bracket 1 plus 0.08. I'm following this formula, my friends. Raised to negative N. So raised to negative 3. And then everything to be divided by R, where R is 0.0 what here? 0.08. So then I would want you guys to do me a favor. In your calculator, you will say 1 minus, open brackets, please. Open brackets. You must always open brackets here. You will say 1 minus, open brackets. So we have here 1 plus 0.08. You close your brackets. You say raised to. In your calculator, raised to is like this. Raised to negative 3. And then you say equals to take care of this upper bracket. This over is like a bracket telling you, first of all, give me the numerator. So you must say equals before you say divided by 0.08. Before you say divided by 0.08, you must say equals. How I wish it's everybody who was getting that 2.5771. How I wish. And please, we would rather repeat this 10 times until everybody gets it. How I wish it's everybody who was getting, in this case here, 2.5771. So is that figure okay with everybody? Everybody should have a calculator and they should be able to give me this figure. All right. Everybody should be able to give me this figure. Are they able to get this 2.5771? Where I'm alone with only BR and RODA. Then you can start with this one. You can start with this 1.08. You say raised to negative 3. You start with the brackets. You say 1.08 raised to negative 3. You say equals first. And then you say 1 minus that answer. 1 minus that answer. And then you say equals. After you say equals, whatever you get will come and say divide by 0.08. Divided by 0.08. A good student is asking, Walim, what if we use the table? Rono, Kasneb is Kasneb. Nowadays, Kasneb, they will give you a figure here, which is not in your tables. You really cry. It's always good to get used to applying the formula. So si Pierono Have you been able to use, in this case here, the calculator? Have you been able to use the calculator? Once all of us were able to use the calculator and we're getting this 2.5771, can we kindly push here, in this case here, our thumbs up like that for Mwalimu to continue? For Mwalimu to continue. Yeah, great. At least I can see some thumbs up there. So then we have this one, which is really nice. Then the present value of lease liability, the present value of lease liability, present value of lease liability will be this 15,521, 200 times the PV you guys have been able to get there, which is 2.5771. If we are correct, we should be able to get an answer that is identical to this, save for a few rounding off errors. If you're correct, we should be able to get something that is identical to this. Yeah, if you're correct, if you're correct, if you're correct, if we are correct, we should be able to get, yeah, 39 million, blah, 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 blah. Is there somebody who has tried using the figure they have in their calculator? Somebody who has tried to use like many decimal places? Somebody who has tried to use like many decimal places, the figure that they have in their calculator, I tell them something, because the more the decimal places, the more accurate we shall be. The more the decimal places, the more accurate we shall be. Anybody who can try using, remember, the figure you got in your calculator will be 1 minus 1.08 raised to minus 3, and then you divide this by 0.08. Is there somebody who can try, in this case here, using the figure they have in their calculator? The figure they have in their calculator, the figure they have in their calculator. The figure they have in their calculator. The figure they have in their calculator, it's coming closer, coming closer. So we are getting, ladies and gentlemen, that this is 39.999 or whatever million, which of course we shall be able to take to be approximately what there. We shall be able to take this to be approximately 40 million, because we appreciate the fact that fair value of lease liability will always be equal to fair value. The present value of lease liability will always be equal to fair value. So, ladies and gentlemen, after that, are we together first of all here? Are we together as in how we have been able to get this present value of lease liability? Are we together? Are we together? Great. And we shall be doing this often. Now, ladies and gentlemen, remember now this is the total loan. Remember, the lessee is not a very rich man. He's supposed to pay this amount like at once. He's supposed to pay this amount like what year at once, but he can't afford it. That's why he's been given, in this case, to pay this in 3 equal installments. So because he has been given this as a loan, the next step after you get this, step number 2, mention there step number 2, the next step will be for you to prepare a loan amortization schedule. So step number 2, you shall prepare a loan for the lessee, a loan amortization schedule. You shall prepare a loan amortization schedule. So remember here, you're going to have years. So years we have 1, 2, 3. You're going to have opening balance. You're going to have interest. You're going to have, in this case here, installments. You're going to have installments, ladies and gentlemen. You're going to have the principal amount paid, principal amount, and then you're going to have closing balance. Very easy. Please let me know once you guys are able to just write this particular table, the titles. Once you write like that, let me know once you're able to write that. So for those of you, of course, who would want to join RCM, which now is the #1 college in East Africa, do not hesitate. Please, this is our number. This is our phone number, and ensure that you are joining us. So I teach financial reporting, the 6 p.m. class. I teach advanced financial reporting as well. So we shall be able to do what here to meet in this. Yeah, already we are here. Thank you so much, Rono. There must be a ninja who is not yet here. Let's welcome them. Thank you so much. So then, have you been able to draw this, ladies and gentlemen? Have you been able to draw this skeleton? Have you been able to finish drawing this skeleton? Thank you so much. I shall start with the installments because installments are very easy. How much is this ninja paying every year? They have given us the figure that is being paid every year. The installments don't fluctuate. The installment you can see here, they are 15, the lease rentals, they are 15, 521, 200. 15, 521, 200. 15, 521, 200. 15, 521, 200, like that. And then now, ladies and gentlemen, I will come right away here and ask myself, what is the opening balance? Opening balance will be the total loan you are given. You are given 40 million. Opening balance is 40 million here. Opening balance is 40 million there. So this is column A. Call this one here column A. Call this column B. Call this column C. Call this column D. Call this column E. So have they given us the rate of interest? Oh, yes. And to get the rate of interest here, the interest amount, you shall take the rate given, which is 8% times column A. Because remember, interest is normally levied on opening balance. Interest is normally levied on opening balance. So then can somebody in this case here give me this interest amount? 8%, we had given you for the beginning of the, or rather for the whole year, the beginning of this year, we had given you 40 million. So then what is 40 million times 8%? What is 40 million times 8%? BR gives me a figure of 3.2 million. BR gives me a figure of 3.2 million. 3.2 million. Ladies and gentlemen, remember, every time you are paying an installment, every time you are paying an installment will always cover interest plus what here? Plus principal. Every time you pay any installment, it will always be interest plus principal. So I have interest and I have the installment, then how do I get the principal? If you make the principal the subject of the formula, if you make principal, it will be the installment you have paid minus interest. The installment you have paid minus interest. So in short, to get D, I'm taking C minus B. To get D, I'm taking cow minus boy. I'm taking cow minus boy. So is there somebody who is able to give me the first one here? So I'm taking this installment minus the interest paid. So is there somebody who is able to give me this principal amount? Please, but we only have very few minutes actually. I'm over time, but we shall overcome. So according to J, it is 12,321. It is 12,321, 12,321, 12,321, 200. 12,321, 200. Thank you so much. Thank you so much. Yeah, so many guys have been able to confirm there. No, it's only J by the who confirmed. How about the other students? Are they able to get that 12,321, 200? Yeah, thank you very much. Then what do you think am I going to do to get closing balance? I know I've gone for loans in banks. I know whenever I take a loan, the closing balance can only be ascertained by taking opening minus principal. So whenever you want to get closing balance, you know your loan can only reduce by principal amount. Closing balance will be opening minus principal. Don't subtract interest. Don't subtract interest. So anytime you want to get this closing here, E, you will take in this case here the opening, which is A minus the principal, which is D, minus the principal. It's only principal amount that can only reduce my loan. So can somebody tell me this 40 million minus the figure that you have there? 40 million. So from J, we have 27,678. So we have here 27,678, 27,678, 27,678, 200. Audrey got a different answer. Or is she the one who is correct? Please use in this case your calculators very well. 40 million minus 12,321, 200. Should be 800, right? Should be 800. Now, my good students, what do you think in this case here shall be the opening balance year 2? Opening balance year 2. Should be the closing balance of year 1 that we bring down. So whatever you have there as your closing balance of year 1, when we come to year 2, this is what I will begin with, 27,678, 800. Is that okay? So now I've been able to set the tune, the tempo. So to get interest for year 2, you will take 8% times the figure that you have here. 8% times the figure that we have here. Is there somebody who can just give us this figure very fast? Because now we have 7 minutes only to go. 7 minutes only to go. 7 minutes only to go. So we have here 221, 221, 221, 4304. Thank you so much. I'm so happy that you guys are following. Then you go to the principal amount. We know now it is this C minus the interest paid. So you take this C minus B. You take C minus the interest paid. So this one minus this. Is there somebody who could be having this figure? Audrey has given me 1330. So we have here 1330, 1330, 68, 96, 68, 96. And then now we come to column E. Column E, we are taking A minus this principal. So the A for year 2 is this. Now minus this principal here. Minus that principal. And then you give us an answer pretty first. You give us an answer pretty first. Give us an answer pretty first. So remember, closing balance, you'll take the opening balance minus the principal amount. So according to Audrey, we are getting 1437. 1437, 1437, 14,371 actually. 371 actually. 904. 14,371, 14,371, 904. So this is what I bring, and almost we are almost through. So 14,371, 904, 904, 904, 904, and then, ladies and gentlemen, I will be able to compute interest here, which is 8% of A, 8% of the opening balance. 8% of the opening balance. Is there somebody who could be having a figure there? 8% of the opening balance. What do we have there? 8% of the 1149. So we have here 1149. So we have here 1149, 752, 752, 1149, 752. Now from there, then we should be able to get the principal, which is C minus B. C minus B. So this minus this. So is there somebody who has the principal here? Is there somebody who has the principal here? Is there somebody who could be having the principal? Anybody who could be having the principal? 14,371, 14,371, 14,371, 14,371, 14,371, 14,371, 448, 448. Now let me give you a very important thing you're supposed to know. You know, your loan should always amortize to zero. Our loan should always amortize to zero. So when you are subtracting, for example, you take this minus this, you may not get exactly zero, but it will not be clever of us to write that answer there. But for example, I'm getting 300. You know, 300 out of these millions is negligible. Is negligible. So we shall never write, ladies and gentlemen, what in this case here we have what here, what and there. So, but of course, you'll agree with me that this minus this, whatever answer you get in form of millions is an ochugunu, is very, very small, is very, very small. So then the third step, as we finish this, which I will not be able to finish, we shall be able to go to the third step, which now is the ascertainment of what we call the right of use. Right of use. And then once we get this right of use, we shall be able to get depreciation. So after that, then we shall be able to do what we call financial statements, extracts. 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 If they wish, they can ask us to give them journals. Then I'll be able to give them journals very, very easily. So because of time, we can't finish this, but it is my belief that you guys have been able to get something out of our today's class, however small. However small, it's my belief that you guys have been able to get something out of this class. All right. And as, of course, you sign off, please don't hesitate to get out of your way and bring as many students as possible to RCM. RCM right now, sisi ndio tuko, sisi ndio wenye kusema. Of course, sisi na nyinyi. So in that case, this is our number, 0793 555 000, 0719 525,000. Please write that number somewhere. And then most importantly, ensure that you are bringing all your friends for BDA, for QA, or CPA papers, or CIFA papers, or CFFE papers, and we charge Kenya shillings 4,800, which as well you can pay in 2 installments. Thank you so much. Thank you so much. We shall overcome. Amini Mwango, ACCA, we have tried it, but you're not able to get great numbers. You know, we are a low-cost school, all right? And because of that, we work with numbers really. So ACCA, whenever I try, I can't get 5 students. So for now, no. Joining on Monday, how will I recover the covered classes? So remember, Felicitas, at RCM, we have a great tool called the Learning Management System. In this Learning Management System, you will be able to get access to all the videos covered. Videos for the classes covered, we normally hang them in the Learning Management System. This is a game changer to RCM students. They know it. So remember, under LMS, first of all, we give you access to last semester's video. So we give you access to complete syllabus in the LMS. And then now, ladies and gentlemen, in this LMS, we also keep on updating the LMS with what you're covering every other day like that. And then remember one secret, the videos in the LMS, you shall always watch them at a higher speed. Is there somebody who has started, in this case here, watching these videos at a higher speed? Say at 1.5, never go to 2. 1.5 is the highest. 1.5 is the highest. You can see Angelica, yeah? 1.5 is the highest. 1.5 is the highest. So thank you so much. See you guys later for Advanced Financial Management today at 6 p.m. Thank you and be blessed as you purpose to join